Well, good morning or good afternoon or evening, wherever you are. My name is Doug Ramshaw. I'm the president of Minera Alamos. And in part two of our conversations with Minera Alamos, we're very lucky to have Willem Middelkoop join us today. He's a fund manager at Commodity Discoveries Fund in Europe. And Willem is going to provide a little bit of an overview on the art of discovery investing, and then we're going to turn it more into a fireside chat between Willem and myself. At any time during the broadcast today, there's a Q&A that you can submit questions that we can, if we have time later in the show, Willem or myself, more likely Willem, will be here to answer questions. So please use the tabs there. And in the meantime, without any further ado, I'm going to hand this over to Willem. Willem, great to see you. Thanks for joining us.
Well, thanks for the invitation. We've been knowing each other for a few years, met on the different conferences. Actually, it's the first time I'm in a hotel room back again since, I think, February last year. Well, I prepared a few slides as an introduction. I started a commodity discovery fund in 2008. I was at the top of the last commodity cycle. I've been a discovery investor first as a private investor around 2005, 2006. I was publishing the Middelkoop Discovery Alert Service. We tipped Aurelian resources very early stage. I think it was at the late 2015. And Aurelian resources was one of my lucky investments as a private investor. One could call it beginner's luck. I bought 10,000 shares for 30 cents, and then they made this amazing discovery in Ecuador, the Frutal del Norte deposit. Went into production last year, so I experienced the full cycle. And at a certain point, I decided it wasn't a smart idea to give my best stock tips to sell them for $99 to other investors, and somebody advised me to build a fund. So I built the Commodity Discovery Fund around 2007. We went live in 2008, and since then we always try to find the new Frutal del Norte, to find the new world-class discovery, and we've made quite a number of investments since 2008. My timing was perfect, as you can see here. Was the top of the last commodity cycle. Commodities, the valuation of commodities compared to the S&P 500 was at a top around 2008. So we experienced the big slide down, and actually most investors must have heard this before, but the valuation of commodities at the end of last year was at a 100-year low. So as an investor, I think this is a great point of entry, and we had an amazing 2020. We ended the year up 85%, and our assets under management grew from 40 million to 100 million euros, so that's 160 million Canadian. Currently, we're up another 10% in assets under management. We see very strong inflows. Many people, many high net worth investors. We have some 1,200 high net worth investors. Many of them are getting a little nervous by the amount of money printing, and well, that results in a very strong growth of our fund. This graph shows the outstanding participations. So it shows some of the investor interest over the years. And we were very fortunate to have net inflows every year, even in the worst years like 2013 or 2018, we still had net inflow. And I think that makes us one of a kind, because many commodities, of course, were confronted with huge outflows. Last year, as I said, we were the top performing resource fund. We ended up at the 9th place on the Bloomberg list of top performing funds. This is from a database of 17,000 funds, all strategies. And our average return over the last 5 years is 18%. And we concentrate on the early stage early stage companies, exploration companies. And we also concentrate on starting producers. And that's why we like your company, Doug. That's why we're invested, because we all know that in the mining cycle, you have two phases which can make you the money. That's the discovery cycle, discovery phase. And when a company starts production, once most of the companies who start that production see a re-rating of 100 or 200%. But the core of our funds are investments in exploration companies. Our exit strategy is very simple. We just wait for the buyout, and we've enjoyed 65 buyouts in the last 12 years. Last year was a little slow. I think that was due to Corona and COVID, because traveling was a little problematic. We already had 2 new buyouts in our portfolio this year, so I think this year will be a nice year. Our best performing holdings last year were the Grey Mining, Sydney, Australian listed company, working on a wonderful gold discovery in the Pilbara. Our fund is not only concentrating on the North Americas, but we invest worldwide. So our second largest, our second best return was Greatland Gold, also working on a wonderful gold discovery next to the old Telfer mine owned by Newcrest, was up 1,840% last year. And we also had a big winner in Toronto. Toronto listed ISO Energy, of course, a uranium discovery. Uranium is getting interesting again. So these cases have really helped our returns in the last 12 to 18 months. If we look at the graph of Greatland Gold, you see an incredible run. But actually, we started to invest in 2018 when the first discovery was made. Then for almost a year or over a year, nothing happened. Shares went actually down. We've experienced the same with NextGen Energy a few years ago. So it may take a while before investors start to notice that a world-class discovery is in the making. And once the general investors begin to understand what kind of value is created by a discovery, the stocks will go up, as a 10-bagger, 1,000 or even more %. Another great example is our investment in Great Bear Resources. They have raised over $70 million in the last 5 years. They still have over 50 million of cash. They generated 800 million gain in a market cap. And for every dollar spent on exploration, $25 of value were created. So this shows why we love discovery investing. If you invest in a small company making a large discovery, you'll do very well. And the core of our portfolio are the top 50 exploration companies working on the best discoveries worldwide. Doesn't matter whether they are discovering gold, silver, or uranium. A world-class discovery is always a value creator. If we look at the graph, then we can see in the last few decades, the number of large gold discoveries has been declining. So I think we're in for a perfect storm, rising gold price, a strong demand, not only for gold, but for many, many metals, and fewer discoveries. So the discoveries which are made are highly valuable, and I think this will continue. Of course, the gold price has been lagging for the last 6 months. We've been in correction since August. I think the correction is almost over, and Bank of America has been calling for $3,000 gold this year. So that's a very strong indication that the big guys on Wall Street, they expect the dollar to go down, they expect the money printing to continue, and that's of course very beneficial for us hard asset and precious metals investors. If we look at the fundamental situation for gold, physical gold, total world production, yearly 100 million ounces, total discoveries, world gold discoveries, well, around 25 million. So We're depleting reserves, not only in gold. We see that with many metals, also in the copper space, the nickel space, and we see the gold producers increasing dividends. Now the margins are going up. So I think it's a wonderful opportunity for investors in our space, especially after the last correction. We have a list in our office based on our own supply and demand study, and it shows that 9 different metals show a production deficit. So the world physical demand is larger than total world mine production, and that makes this space so interesting. Well, that's my introduction. So I hand it back to you, Doug.
Oh, that's great, Willem, and yeah, I think you highlight very much the importance of that first part of the Lassonde curve you referenced earlier. Interesting when you go through those slides, you're very agnostic, both commodity-wise, but also kind of where a company is listed as well. And I think, when we talk about discovery investing, I was very lucky in the early part of my career. I witnessed that kind of 1990s discovery cycle, where there was a real difference between, I think, Canada and Australia. And I say that with regard to the capital structure of companies. Back in the mid-90s, and we were seeing the Arequipas of the world and the others that went from 30 cents to $30 in 18 months before its buyout. Companies back then, if they had more than 20 or 30 million shares out, there'd be people with pitchforks and torches saying, you've got to roll that back. And in comparison, the Australian market, and I'll be very interested in your take about value creation in Australia and the TSX and the difference between the two. They had the hundreds of millions of shares out. I think it was interesting when you bring the example of Great Bear up, that when that discovery was made, it was quite nostalgic, I think, for a lot of people associated with it, that it was a 2018 discovery in a 1996 share structure. And you had this incredible the talk like you saw in Aurelian and many others. What do you think's changed? Because in terms of capital structure, and maybe it's just as easy now to have these big wins in Australia as it is in Canada. Because share structures seem to be more aligned in terms of the exploration side of things.
Well, from a point of view of value creation, I don't care whether there are 10 million shares outstanding or 1 billion. We always look at the market cap. So if the market cap is 10 million with 1 billion shares outstanding, I don't care. Of course, I love it when there's a very small free float, but actually a small free float is also troubling for a discovery investor who needs to build a position after a wonderful discovery hole. And when there's no financing you can join, you have to you have to compete in the market for a very limited number of shares available. And it's my experience that the rise in price percentage-wise is much larger when you have a small free float. And if you compare that to the situation in Australia, where we have a discovery hole, same kind of market cap, but a huge free float and 1 billion shares outstanding, there's so many small investors who own 100,000 millions of shares, and they tend to be more willing to sell. So I think the situation is more liquid from a trading point of view in Australia. But we were surprised to see that the North American investors are not plugged into the Australian markets and vice versa. And I was speaking to a very, very experienced fund manager who's running his own home office now, and he's one of the big guys in our world. I won't mention his name. He's got over $100 million of investments in the early stage and the development stage. And I asked him about two interesting Australian breaking discoveries nowadays. And actually, I said to him, why don't you invest? And he told me, I can't. My broker, my plumbing system for trading doesn't allow me to buy Australian shares. This is a big guy. So we are very fortunate that many of the serious investors in our space in North America are ignoring Australia, and we had our best wins in Australia in the last few years. So we have to work day and night now. That's a problem. But as an investor, it's amazing. I always tell people, investors, it's like walking into a club and you have 200 beautiful girls and they all want to dance with you, and you can just pick the nicest and the prettiest, and when you don't like them, you choose another one. And there's so many listed exploration companies out there. I think there are over 1,000 to choose from. Even in Australia, you have a few hundred.
So, and in that regard, like, for people that are new to the sector and looking and looking for pointers, I mean, to drill down in this giant universe of exploration companies, in terms of your process, I've known, obviously, when there have been discoveries, you've been one of the first people on the phone to either offer money or want to be in on that first financing. Is it, like, in terms of your process, is it fair to say that you don't mind missing out on, say, the first 30 or 40% for, and jumping in, as opposed to like that chart of Greatland's a good example. They, in their case, they had the discovery and it took off. But in many others, if you come in too early, they have a very different looking chart. Exploration is expensive. It comes with dilution and everything else. So what's your process for sniffing out in that 1,000+ group of companies where the opportunities are for you to take advantage?
Yeah, of course, we like 10 baggers, but 10 baggers also, if you concentrate on the 10 baggers, you always also will have the large losers bringing damage to your portfolio. So since our fund has grown now to over 170 million Canadian, we tend to be a little bit more selective. And over the years, I've also learned that stocks, they run in phases. So when you see a company breaking out of a trading range, and even the best discovery stocks have trading ranges, like Great Bear has been in the trading range now between 13 and 19 for over a year. So we scaled down after we had a huge run. Chalice Gold is a great example. Great PG discovery in Australia, had a huge run. And once the valuation reaches 1 billion, same happens with Great Bear, same happens with the gray mining. Once you reach 1 billion, there's a psychological level that investors start to take profit. They cannot understand that there could be a buyout of 4 billion or 6 billion, which have been there in the past. Voisey Bay was bought out over 4 billion in the 1990s. There would have been 10 billion now. But when a stock reaches a valuation of over 1 billion, we sell half. And then we wait, and we want to see a breakout of the trading range. And then we enter the stock again in a massive way. So we don't care that we missed the first 100% or 150%. We entered Great Bear Resources, as you know, around $2. And we bought in the open market 3% of all outstanding shares because we were convinced that it was a special situation. And then we had this run towards $15, $16. So it doesn't matter if you entered $1 or $1.50 or $2. So in the rare world-class discovery situations, the Great Bears, the Greatland Golds, the Gray Minings, Aurelian Resources, NextGen Energy, it doesn't matter if you enter the first day or the first week, but you should enter the first month of the of this breaking situation. And of course, you can never be sure whether it will turn out to be a world-class discovery. But in our funds, we have the benefit of being able to spread our funds among the top 50 of discovery situations. And some will fail, some will be very successful, and some will do quite well. And this has been a great great learning experience for us, and we're optimizing our system every year, and we tend to focus more on the larger discoveries now, and we don't want to have hundreds and hundreds of small toes in the water like we had in the past. So we're getting more selective, and this is only 50 or 60% of our portfolio. The other part of our portfolio is invested in highly liquid ETFs. So we can play the uranium space, or we can even go short by owning some of the ETFs who profit from downturns. And we can also add volatility ETFs who profit from volatility. So that's a perfect way for us to hedge the risks which are inherent to our sizable positions in the early stage companies.
I've had a thought, looking at how the markets moved in 2020 and how we were seeing it when gold broke through 1,400 in the summer of 2019. One of my soapbox issues with the sector for so long has been that we spread too little capital too widely, and then we wonder why nothing actually ever gets done. Why the number of discoveries has been decreasing. I think it's been a function of having so many companies, and they all clamor for some of that capital, but it's not enough to actually do too much with. Now, in the second half of 2019, when gold broke out, we actually saw very concentrated flows of capital to probably the top 15% of companies. And I thought it was actually made for a very healthy market. It's what as investors we should be trying to look for, the cream of the crop. And 2020, the second half of 2020 was the complete opposite. It was very much the rising tide lifts all boats. And I'm thinking to myself, here we go again. You get all this noise that we as investors have to kind of churn through to see where that cream is, where those opportunities are. Like from a fund side, like how did you view that second half of 2019 market, which was a great stock pickers market and I thought beneficial to the sector, compared with what we saw in 2020, where there was kind of almost a pent-up demand with a lot of these companies that hadn't moved, and then they had their shift and have probably got range bound or have declined since the spike in the summer?
Well, because the downturn took so long in our industry, many people were very hesitant to put money at work, especially in the exploration and development stage phase. When gold broke out over 1,400, the only real inflows we witnessed were in the producers. So, and this is typical for our for our sector, that once you get a recovery after a long downturn, first it's only the seniors who are really benefiting, and the royalty companies, of course. So at that first phase, you should have as little money in exploration stock as possible. And then after the first run of 4 or 5 months, even Warren Buffett entered Barrick in the late 2019 period. And then when you have profits there, you should sell them, you should sell the seniors and the royalty companies, and you should put all their money at work at the exploration companies, development stage companies who have the best projects, because they will have a wonderful rise even when the producers are going down. The gold producers have been going down by over 30% since August last year. And the CDNX, the index of the smaller companies, resource companies in Canada, is up actually in that period. Our fund is up since August 2020. So when people ask us, why do we have to pay large fees to you guys? We have performance fee of 20%. We show them the difference. The GDX was up 24% last year. We were up 85%. Well, that's why you pay a performance fee, because we manage our portfolio very active. And the older you get and the more experience you get, the better you can play these different phases in the market. But one more comment on the Canadian market and the Canadian investment culture. I think the Canadian culture is highly poisoned. And what do I mean? The people in the industry are not looking for the best discovery. Most people in the industry, they're in the business of selling shares, and they don't care to who they sell shares. They don't care for which company they sell shares. Look at what Canaccord did at the cannabis run up. They don't care if it's Bitcoin or crypto or cannabis, as long as they can sell as many paper as possible. They behave like central bankers, and I'm getting more and more annoyed to join this circus. And well, that's my rant for the day.
No, oh no. Well, I mean, I think it's funny when we were battling as a sector in Canada, that kind of at the time, a few years back, it was a double-headed monster of crypto, not crypto like we're seeing it today on steroids, but the early crypto kind of companies and marijuana.
Yeah.
At a time where commodity prices certainly weren't serving the mining industry, I think a lot of people pointed to Australia and saying, look, there were no distractions from these other sectors there. And actually the resource sector was doing very well down there, well in advance of the Canadian area. And I'm seeing it even today that, and I do think that there's a cultural difference between the investing psychology here in Canada over say in Australia. We seem to be inundated with whatever the new next best thing is, and whether it's crypto being reborn now, or marijuana deals because of US legislation, or in response to COVID testing, testing companies, where I've seen stocks go from 20 cents to $2, also right back to 60 cents straight thereafter, or 30 cents to $16 down to $2 now. We seem to be crazed by anything that has even a semblance of momentum to it, and it sucks attention away. Like we seem to feed off other industries. So Canada doesn't, cradle these sectors themselves, but we create an investing mentality that craves whatever is the newest, hottest thing that can be a distraction for kind of the sectors like you and I are focused on.
But the tricks which are being played by the brokers in Canada and insiders, this is not allowed in Europe. They would all be in jail. And in Australia, the regulators are much more serious than in Canada. In Europe, the regulators are even more serious. But the amount of insider trading I witness day by day, I could start a website and putting them all down there every day. This is like Europe in the 1970s before the regulators stepped in. And in the 1970s, insider trading was seen as something positive. You were smart when you could trade on insider tips. And that's still the culture in Canada. And it's one day they'll pay a very high price for that. And it's a reason why more and more investors no longer want to put any money in the Canadian resource market.
Mm-hmm. Mm-hmm. Yeah, no, I mean, I think as a sector, there's been, it doesn't help. It's obviously a very cyclical business, but we've seen wholesale destruction of shareholder value from the very biggest companies to the smallest. I think what's been encouraging for our sector, and hopefully encouraging to investors, is the way that the majors have handled it. I'm sure your takeover count's going to go up this year, but in many ways, one of the better things that came out of COVID was and very few good things came out clearly, was it forced as we had this rising gold price and at a time where majors had rationalized their operations to function in a lower gold price environment, they were now spitting off all this free cash. And instead of repeating the sins of the past that they gradually got over and immediately jumping on M&A, etc., to deal with this depleting resource base, they cleaned up the balance sheet. I think that's going to be the prelude for a lot of M&A in the second half of this year and through 2022, and we're starting to see certain dominoes falling now. But I think it was good because I think those rising dividends, companies reintroducing dividends, all that sending the message that, companies are approaching the business of mining like a business in any other sector. But at some point that has to feed through to M&A. But I think it's good. The majors need to send the right message. And I think the mid-sized companies and the juniors need to follow on from that as we make this a more acceptable arena for investment. But it should mean you have a very good 2021 on takeouts, is my guess, and 2022 too.
Yeah, well, it started with a bang. I think we have seen 4 takeover situations in the last week or 10 days. 2 of them in the fund we owned. Battle North we sold last year was taken over as well. Very interesting to see Australian companies moving to North America and seeing the value there. I think there's a reason why we see more world-class discoveries in Australia than in North America is due to the fact that in Australia you have a lot of cover, sand cover. So many areas in Australia have sand cover around 50 to 300 meters. And with the old techniques, geophysical techniques, they weren't able to look through the sand cover. And with the better systems which have been developed over the last 2 decades, new discoveries are being made because we can look through the sand cover. And in Canada, I think we're in a situation that Canada has been explored much better than Australia. I think there are very few places in Canada where not at least 3 or 4 geologists have picked up some rocks. So it's very rare to make a world-class discovery in Canada, and what Great Bear Resources has accomplished is a proof of this thesis, because that project has been explored for decades actually, and it was the smart work of geologists by Great Bear to relook at all the data and to come up with a new thesis and to make the discovery. But it is not a part of Canada which hasn't been explored.
Yeah, no, I think that was the biggest surprise in Red Lake. People drove by that project for decades, but a lot of discoveries do come from just having to go through multi-generations of exploration, and with more data comes more guidance and vectoring in for the next iteration of a company that to make that discovery. I mean, in these kinds of cycles we're in now, you see a lot of retread projects, and often they're looked at with disdain because it's like, oh, that project comes around every cycle. But I think there'll be examples where a retreaded project, eventually it's just the sheer amount of data will have helped one set of geologists to take advantage, and also to take advantage of the dollars that have been spent before. Again, in a very capital intensive business, anything you can do in that regard. You mentioned jurisdictions and the difference between Canada and Australia. The world is opening up. There was a time where a lot of countries now, which are in vogue, certainly weren't in vogue 20 years ago. Where would you, if you could pick a jurisdiction and I'll keep you to one jurisdiction where you think over the next 10 years, investment policy and mineral code and everything will allow for the investment in it. Where do you think some of the great future world-class discoveries can be made, jurisdictionally speaking?
The Pilbara, Australia. The Pilbara is I visited the Pilbara myself in 2017 after the discovery of the gold, the watermelon-sized gold nuggets by Novo. It was a mystery. It's still a mystery where the gold came from. You find these nuggets in 2.7 billion years old rocks. It's reworked, and it brought us to the Pilbara, and we started to study the Pilbara, and it's highly interesting situation, because you have this desert in the northwest of Australia. Nothing is there, only a few iron mines, huge iron mines. Karata actually was a private city 2 decades ago, owned by Rio Tinto. It's now open. Everybody can live in Karata. It's bloody hot out there. It's like Saudi Arabia. But the Pilbara, it's a craton, what geologists call a craton. You have 2 to 4 billion year old rocks outcropping, and you'll find everything there, from diamonds to gold to nickel, iron. And it's still not that well explored. And the number of discoveries situation we've seen within a few dozens of kilometers, Artemis, De Grey, Novo, Azure Metals has a nickel discovery now. And there's only one guy who really understands it as an investor, and that's Mark Creasy. Mark Creasy is this famous, he's like Eric Sprott from Australia, but has more technical background. And he invested in many early stage companies, made many large discoveries. And he owns a lot of the land there. And Quinton Henning was the guy who went to Mark Creasy and told Mark Creasy, I have this thesis. There's lots of gold to be found in the Pilbara. And people laugh about Quinton Henning, but he proved there's a lot of gold there. He still has to prove he can mine it on a profit, but I think he's been working on a wonderful new technique in which he can mine gold without any chemicals, without any water, just by using the new ore sorters, which are also used in the diamond industry. I visited Lucara Diamonds in Botswana. You know how they find the diamonds in the core? Just by ore sorting. So new techniques are being developed, and the Pilbara, I think, will bring many surprises. On the eastern part of the Pilbara, you have the discovery by Greatland Gold. There's the Winu discovery by Rio Tinto. There's a staking rush going on, and I'm surprised that almost all North American investors, they ignore it, because this is like Nevada in the 1950s or 60s.
Mm. Yeah, no, I it's an interesting point. I think people, the early, when Pilbara entered our vocabulary over here, it was all to do with Novo, but I think people are, unaware of a lot of the other stuff going on in the Pilbara, mainly because they probably think that Quentin staked all of the Pilbara, but as you said, that there's plenty of land down there that is being worked on. As we wrap up, and for our audience, and please fire some questions. We've got a couple which we'll get to. And I know we appreciate your time today, and I know you've got another thing you have to go to. So we've got about 10 minutes left. Before I go to a rapid fire question round, I wanted to have some fun with you. And the other Q&A. Clearly you've had some great successes, and we've mentioned some of those, but I think when we're looking at how to hone our strategy of investing in the earlier stage, like if there are some lessons associated with some of your bigger mistakes, which you've taken with you now through your investing career? I mean, often some mistakes can be really costly, but that's a great investment if you don't do them again and repeat them in the future. So maybe share perhaps some of the less impressive moments that have actually helped you now as a discovery investor moving forward.
Well, the first book I read on investments was, I think, over 25 years ago, and that was on technical analysis, and the trend is your friend. I think that one always stayed with me. And after that, I worked as a journalist for 20 years, so I was always a guy who was thinking things over and analyzing it. And I thought when I made the right, when I've done the right research and there were good fundamental reasons to invest, it should work out. But I became humble during the last correction, because you can be wrong for the right reasons. Mm-hmm. Or you can be right for the wrong reasons. It's better to be right for the wrong reasons than to be wrong for the right reasons as an investor. So I started to study technical analysis again and learned that it's much more important to know where you are in the cycle. I always want to invest in gold as a hedge for my net worth, but why invest in gold when it goes down for 6 years or 7 years? So we changed our system, we changed our model, and we follow the strongest trends now. So first we analyze which trends in the metal space are the best. It's palladium now, it's copper now, gold is recovering, uranium is turning the cycle. What's one of the best entry points for an investor is first you wait until the downtrend ends, and it always goes on longer than you can imagine. Same for the uptrends. And then you see a first recovery phase, and then you shouldn't buy, and then you see a retest of the bottom, and only after you've seen a second and higher bottom in the chart, that's the best place to that's the best time to invest, to enter the trade, because after that you often see a very strong rise. And if you follow that system time and again, and I'm pushing myself to be more systematical, because we tend to fall in love with stories, especially with discoveries. But I always want to see the discovery has to be proven by the trend. So if the results are wonderful, but the stock is still on a downtrend, something is wrong, because insiders are not buying. So I want to see proof of insider trading. Actually, the great thing, that insider trading is a bad thing in Canada, but the great thing is it tells you a lot. It tells you a lot.
Yeah. No, I guess it's probably not appropriate for a lot of people listening. I can just say, from my perspective, the last 3-4 years have been my best investing. Really, as a function of getting married. I suddenly realized that it wasn't all my money. It was half someone else's. And then my wife, who's a lawyer, pointed out she's a very good lawyer. So really, it's all hers. And I'm not going to fight her on that. But what it allowed me to do was and similar to what you were saying earlier about companies kind of hitting that unicorn level, being very disciplined, not feeling like you had to make your life's fortune on one trade, and not playing. I played GTT way back on the first run after those initial soil anomalies, whatever it was, 6-7 years ago. And I was out on that first run. The last paper went out over $2. It came all the way back to 70 cents. I didn't play a round trip. I was out, moved on to something else. You don't have to look for 10 baggers, although they're fun to achieve. A series of 3 baggers where you're repurposing their capital into something else that's now got legs to run. And so investment discipline is really important. We do have a few questions. I'm going to hit you up with those first, and I'm going to finish with my rapid fire questions just to wrap up today. Question out of here from, oops, I just got to get this right. There we go. What are your views of investing in the DRC? And specifically, have you looked at long-core resources?
Well, there are always a few countries where you're not too comfortable with. You know, we don't like Venezuela. We don't like Russia. We're not a big fan of the DRC. We leave that stuff to Robert Friedland. And you have these professional investors like the London family and Friedland. And actually, the guy who really started it all in the London family, Adolf London, he's been very open in his biography about his system. He was bribing people. You know, we don't like that. We don't do that. But some things are
same issues with early companies going into Russia and the former Soviet Union as well. There were dangerous precedents created. I visited the DRC in 1996, right before the Civil War. So when I went out there, it was Zaire, and 4 months later, it was the DRC. But I mean, remarkable geology and mineral deposits. But yeah, it's tough. Let me see. I got a quick question here. This was less meant to be about Minera and more meant to be me chatting with a good friend. But as you are a shareholder in the fund of Minera, I guess someone picked up on that. How does it fit in your portfolio, and how do you value the company at the current stage and say when it reaches 150,000 ounces a year production, which I will add is our goal within the next few years. So if that gives you a bit of a timeline.
Well, I already explained that we like starting producers. So we have a database in which we list all companies with a year in which the production will start. That's a list of 30, 40 companies. And every once in a while, we revisit the list and we decide whether we take a position. And then we look at the technicals, and you had a great run, and now you're in this trading range. And we first want to see a breakout out of the trading range before we employ some new capital.
Yeah, me too. I'd like to see that, but I'm glad we've recovered quite nicely this year after the last couple of weeks. Last question here is, we talked Australia and Canada a lot, and there are a few companies that have gone this path. Do you see value added for a company to dual list in London?
Very limited. We hate trading in London. The system is almost as rigged as in Vancouver or Toronto. They still have an auction system on illiquid stocks. So you're being ripped off by the brokers. But there's a small but high core resource investor group who trades on London, people living in England. And they can really fall in love with the story. Look what happened with Greatland Gold. Well, it's an amazing discovery, but the fan club for Greatland Gold in and around London is large. So it has its own culture. But I'm always very hesitant when people want to co-list the company in Frankfurt or in London. I don't think it's necessary. When you have a good story, you don't need it.
Yeah. All right. Well, I know you've got to fly to another meeting, so this will be very rapid fire because we've got a couple of minutes. So I got 6 questions for you, Willem. Short answers to relatively short questions. If you could have dinner with one mining CEO, who would that be?
That's a tough one. I would say I would like to sit down with a mining CEO who spent decades in the industry, has been on the broker side, has been on the fund management side, and you would be a good candidate, Doug.
maybe in time.
We never sat down one-on-one. We never sat down one-on-one.
I am looking forward to the next time we're having dinner. What's going to be found first? Wits 2.0 or Fosterville 2.0?
Which 2.0 has been found already. The problem is to prove you can mine it on a profit. If that's proven by Quinton, we'll have another Pilbara rush.
Right.
The Fosterville 2.0, I've got much more problems with that neurology play, because Fosterville, I think these kind of deposits are rare. You know, to find such a high grade, relative easy to mine deposit, which actually was an extension of a known deposit, and you know, the shafts were there, so they could profit from it right away. And I think we don't have any positions in all the closology plays there. There's some other much more interesting discovery situations in Australia. Several parts of the country see a very strong boom in exploration, where new discoveries have been made and are being made. And Fosterville South is not, show me the money. We'll invest after a great hole. It's a bit like Red Lake. First, of course, the gold is there, but first show me a discovery hole, and then we'll put money.
All right, I'm going to cut two of them because of time. But if you could hold only one commodity over the next 3 years, what would it be?
Silver. Silver is a very interesting situation. We have a worldwide silver squeeze movement now. I've been studying silver for over 20 years. I've owned physical silver and all the silver investments for over 20 years. There's been a production deficit for over 50 years in silver. President Johnson ended silver coins in the 1960s because he was warning for a shortage on silver. There are hardly any silver discoveries around. Many tricks are being played by the billion banks. One day, I learned this from Eric Sprott, one day the system will break. The paper shorts will have to cover, like they needed to do with palladium in 2018. And then silver will be $100 within a few weeks.
Okay, you heard it here first. If you could hold one stock and only one stock for the next 3 years.
Well, that's difficult.
Well, I put you on the spot with one of these.
Yeah. Because the problem is when I mention an exploration company, a small company, everybody starts buying it, and that's very risky.
Yeah.
So you should always look at risk reward.
Let's talk about something that's run. Talk about something which has run. It's a company. It's like, you know, because I don't want to create any issues on something you really like. You want to buy away. You know,
there's a very interesting situation in Australia, and the name is Cohiba Minerals. And you shouldn't start buying Cohiba Minerals because I think it's an interesting situation. But they're drilling next to BHP's Oak Dam discovery, and these are large systems, and they're really next door, few miles apart. They're finding the right mineralization at depth, 400, 500, 600 meters, 10% copper, but very small width. But that's an intriguing situation, and you have a president, the chairman of the company, who's buying all the shares. Financings, open market. That's an intriguing situation.
Yeah,
that's, you know, we've been buying that. Yeah.
Yeah, it's an interesting point to finish on, that, you know, it's not sometimes before that discovery hole. And this isn't about insider trading. This is someone who's buying, you know, it's people buying just with conviction, eating their own cooking and everything else. And it can be, you can see trends in insider ownership and desire to own more, years sometimes in the making, leading up to the discovery. And so I think alongside looking for drill hole releases and everything else, it's watch management teams, especially watch the financiers, the accountants, the CFOs or whatever, and their insider buying. Follow. Sometimes you can see patterns in management taking a stake and adding to it. There's typically only one reason.
This is all legal,
to sell.
And this is all legal. This is all legal.
Oh, yeah,
this is all open information. So that's what we love.
Yeah. Trust me. I eat my own cooking, and I love to do so with legal buying of my own stock. But it's another tool in the whole cycle of trying to unlock early stage discoveries. Like, look who's putting serious money behind it. Most insiders, when they're cutting a check and buying their stock, that's not money that they're going to get out of the stock again. Actually, I don't like insiders that basically trade their own companies. But when you're seeing that capital being put in, they're putting it in alongside you. There's often, that's the early signs of smoke before you even see the first embers glowing. And another.
You can go wrong. You can go wrong. We had situations where the management and the relatives of management, they're all buying it because they all fell in love with the story, and that it never happened.
Yeah. Well, Willem, I hope this was as fun for you as it was for me. I really appreciate you joining us today, and I hope it was very interesting for our audience. And we're going to hand back to Dasha and the SIX team. Thanks for hosting us today.
Great. Thank you so much to Doug and Willem for the great conversation and insight. I would also like to thank everyone who joined us today and submitted questions. If you didn't get a chance to get your questions answered, or if you think of one after the summit, we'll be emailing out a short survey, and the Minera Alamos team will be happy to follow up with you directly. And you can also find more information on their website at mineraalamos.com. And as always, the summit was recorded and will be available on SIX.com afterwards. So thank you all again, and have a great rest of your day.